Good afternoon, everyone, and welcome to our 2020 U.S. Tax Information Reporting webinar. For those of you who've been with Interactive Brokers for a while, you'll know that this is something we try to do every year to review our 1099s so that you understand and can work with them easier in going to your tax returns. I'm going to ask anybody who has a question to put it in the chat box. If it's an appropriate at the time that I'm speaking, I will answer it then. And if not, I will come back to it either when it's appropriate, when it falls out into the program correctly, or else at the end. And at the end of the webinar on the slide, there is also an email. So if you think of something in a half an hour, which is my usual trick when I listen to a webinar, that then we will, you can email me and that'll come to me and I will answer for you. So first of all, let me introduce myself. I'm Nancy Nelson. I have been with Interactive Brokers for a number of years. I'm working now for them as a consultant, but for many years I was the person that designed and formatted and everything, your 1099s and all the US tax reporting for the firm. But my main background is that I've been a tax preparer for more years than I care to admit. So I tend to come at this from the user standpoint, not the producer standpoint. And because I am a user of these forms, not a, even though I've designed these and I'm familiar, obviously know the rules to do so. Our focus today is on US taxpayers. So if you are, and US persons. So if you are not a US person, meaning that you are not a US citizen, not a US green card holder, and not a legal resident, you're at the wrong webinar. You're later next month. But if you are a US taxpayer, we're going to talk about your returns and how the information reporting that we provide you works into those returns. I'm focusing mainly on individual returns, which is Form 1040, 1040 Senior, Trust 1041, and Partnerships and LLC returns, which is Form 1065. In general, corporations don't receive information reporting. They may receive courtesy reporting, but it's not formal reporting. It generally doesn't go to the IRS. Some exceptions, but that's it. I'm not going to talk about preparing your returns specifically. I will reference them at certain points, and I will try to give you some tips as I go along, but that's really the point. I should say that this is not tax advice. It's really meant to be educational, and that's what we're here for. So we have to start with the legal stuff because webinars are a little like a contest. Hopefully you win more often with a webinar than you do in a contest, but here's our legal statement. I want to talk through this a little bit because I always think it's nice to know a little bit about percentage. I said that for many years I've worked for Interactive Brokers, designing these forms and preparing the specifications for them, and been an individual tax preparer, but I have a fun fact that I also breed and show dogs. And so I'm one of the crazy people that you see running around after the parade on Thanksgiving, showing the dog in the ring and doing those kind of things. So if you hear dogs barking during this presentation, understand that there's not much I can do if they decide the UPS man is on the front porch. So that's my fun little fact. And we're going to only touch on the top 5 or 6 of the information reporting forms because obviously in an hour there's about 30 or 35 information reporting forms, most of which Interactive Brokers doesn't use, most of which you rarely see, but we're going to talk about the main few. Obviously, let's see if my screen does not want to, we're going to talk about the basic ones, and we're all familiar from our jobs from our employers that we get our W-2. A newer one that the 1095C, which is of the form that indicates that we've had health insurance provided by our employer, and a new one this year, which is the 1099 NEC, which is replaced, which is 1099 non-employee compensation, which has replaced reporting for earnings by someone working as a consultant for a company. It used to be reported on the 1099 miscellaneous. It's now has its own little form to go off into the sunlight. And then we have another form that we've all seen probably is a 1098T that's given by an educational institution for which tuition is paid to them. Banks and lenders tend to issue 1099 interest, which brokers also issue. 1099R, which is for distributions from pensions and retirement accounts, and 1098 mortgage interest expense, mortgage interest that you've paid on your mortgage. And then we have what the brokers and the other financial institutions, and I've listed them out here, the 1099R, 1099 non-employee compensation that we've also talked about, interest, OID, which we'll talk about a little bit in depth, dividends, miscellaneous, B and C. So I'm going to start with talking about common forms, but are less impacted by what activity in your financial account or your investment account. So I'm going to talk first about the, let me get this to move forward, 1099R, which reports any distributions you received for pensions, annuities, retirements, profit sharing plans, IRA, or insurance contracts. And for 2020, the CARES Act, which was the act that started with the pandemic with the first distribution of supplement money and the loans for small businesses, said that required minimum distributions for 2020, if you had an IRA that required a minimum distribution, did not have to be taken. So this form isn't out there as much for 2020 as normal. So we're not going to see this as much. But normally in a regular year, we do see this if you've taken a distribution from an IRA, had an annuity payout, or if you get a pension. So these things are for those payments. They often have tax withheld on them, and they're very common for this. The second one that I want to talk about is cancellation of debt. If for some reason a financial institution, such as a bank or a broker or even a credit card lender, has forgiven your debt, you will get a 1099-C. The forgiveness of that debt, for the most part, is a taxable event. It's something that people don't realize, that they think, I'm finally out underneath this load, but it is a taxable event. It is reportable to the IRS. It's reportable and taxable on a tax return. There are exceptions. It's a very complex area, but and that's pretty much what I'm going to say about 1099-C. And then let's talk in depth, though, about this 1099-R, because a lot of us do have IRA accounts with Interactive Brokers or IBKR, and we may have gotten a distribution. So we want to talk about box 1. That is your gross distribution. Box 2A is the taxable amount. For IRA accounts, and I'm talking traditional IRA accounts, for the most part, that amount will be the same amount, and box 2B will be checked that the taxable amount is not determined. And I want to talk about that when I get all done with the form a little bit. But for pensions where you've contributed money to your pension or in an annuity account, those numbers could be very, very different. So it's something you want to pay attention to make sure you get the bulk of the numbers. We want to talk a little bit about boxes 4 and 14 together, and they are state and federal income tax withheld. Often when you get an IRA distribution, there is federal income tax withheld. The statutory withholding rate on those is 20%. State tax withheld it ranges state by state. Each state has a different law. Obviously, some states have no state tax withholding on it, but other states, and Connecticut happens to be one of them, has mandatory state withholding. So any kind of distribution of this nature, and if you live in the state of Connecticut, would have withholding. And there's several other states that have that. So on these, oftentimes you will see withholding, and you need to make sure that that goes on your return. And then let's talk a bit about box 7, which is the distribution code. The distribution code says what kind of distribution it is. The most common ones are early distribution and no known exception. So say, for example, you take money out of your IRA because you want to go buy a new car and you're under 59 and a half. So you need to pay tax on it, and it is subject to a 10% penalty. That would be a code 1. Code 2 is the same thing, but an exception applies. For example, the new home buyer exception, a disability exception, some other exception like that. Code 4 is death. If you have an inherited IRA, in other words, if you, for example, inherited an IRA from a non-spouse. So if you maybe inherited an IRA from your parent and you must make distributions out of it every year, that would be a code for death. Even if you're under age 59 and a half, that means it's not subject to that 10% penalty. So those codes are important. And 7 is a normal distribution. So if you are over 59 and a half, take a distribution. It's a normal distribution. It's code 7. So those are the kind of things to look for. Now I want to go back to boxes 1 and 2 in this taxable amount. Many of us think with a traditional IRA that when you take the money out, it is 100% taxable. And that is true, but it's also not true. One of the most underused forms on an individual tax return, in my opinion, is Form 8606. If you make a contribution to a traditional IRA and you do it after tax, so it's an after-tax contribution to a traditional IRA. Why would you do that? To make the money grow tax-free. You would do that if you have a pension plan and are not eligible to make a pre-tax contribution to an IRA, or if you're above the income limits for a pre-tax contribution to an IRA. Those after-tax contributions to traditional IRAs add up and become basis in that IRA, and those contributions should be reported annually as you make them on Form 8606, so that when you reach retirement and begin to use your IRA money, they become the numerator over the fair market value of the IRA at the end of the year when you make your distribution. And so it's that the basis is the numerator, the denominator is the fair market value on which the required minimum distribution is based. That fraction times what you took out is the piece that's taxable, or the piece that's not taxable. So 100% is not taxable. Numerator over denominator times the amount you take out, that's the piece that's not taxable. So it's a very important form to keep putting in your return as you make contributions, because it says to the IRS, I've made this contribution, so you don't have to prove it when you start taking the money out. And frankly, who remembers what they did at 30 when they get to be 65 or 71 or whatever age it is, that 71 you have to start taking this out. You're not going to remember what you put in at 20. And the amount has changed over the years. Originally, we could put in 1,000, then it was 2,000, then it went to 5,000. So it has changed over the years. So I hope you find that helpful, and it's something, if you're contributing to a traditional IRA, to look at. Look at Form 8606. I should say that this form has come out. This form has to be issued on or before January 31st of the year following. So this form was issued back the 1st of February. So if you had an IRA distribution last year, you have already received this form. It's out in your account, in your IRA account, in account management under tax forms. So let's move on. The next thing is, we've talked about the cancellation of debt, and I want to touch a little bit on the consolidated 1099R or 1099. Interactive Brokers, like most brokerage firms, issues their 1099s in a consolidated form. And they come all at once in February 15th. And why do we do this? Well, first of all, it has the advantages when you put them all together, you can wait until February 15th to issue them. And why is that important from the brokerage side is that a lot of the information that we need to prepare this form doesn't come January 2nd. It doesn't actually come January 31st. It comes into us over the course of several weeks and even going into March. So we'll talk a little bit about why this form might get amended, but that's why. The information comes into us through our data feeds from outside sources up until March and April. So they do change, but we want to postpone it as long as possible to February 15th. So we have the most information we can have as we prepare it the first time, so that we don't have to keep changing it and confusing you even further. So that's the form that you'll receive, and this is page 1 of it. Looks just like this, and you can see that your name and account information is up on the left-hand side. Our information is up on the right-hand side. And there are 5 1099 forms on this front page. There's the interest, there's the dividend, the original issue discount, the miscellaneous, and the new non-employee compensation one. So we're going to talk about that one first. And because it's kind of, again, one that doesn't affect everybody. The new 1099 NEC, it's new for 2020. Shows if you have non-employee compensation, and box number 4 is federal income tax withheld. Box number 4 is federal income tax withheld on every single form we're going to talk about, except for the 1099B. If there has been federal income tax withheld, you notice back on the 1099R, that was the 4. On the 1099 interest, that's box 4. On the 1099 dividend, that's box 4. It's consistent across all the forms. Non-employee compensation are things from IB would be things if you are an advisor and you got paid advisory fees. That's the main reason this would be issued to you. This form, unlike the rest of the 1099, even though it appears on the consolidated form, must be issued by January 31st. And so it was issued, and then the 1099 consolidated would have been issued on February 15th. So for those of you that have this, it just kind of you get it twice essentially. So don't double it up, but just make sure, so just be aware of what's going on that. So let's go to the 1099 interest. This is one that you commonly also get from banks. It starts off with the interest income that you've earned. This is interest income, and if you own U.S. Treasury obligations or savings bonds, it's not included in box 1, that interest. Only interest income from deposit interest or savings interest is in that. Remember, money market funds that pay dividends, they pay dividends, not interest. So they're not reported on this form. Something that we often forget. So we have interest. If you had a CD and perhaps cashed it in early and had a penalty, that's reported in box 2. U.S. Treasury obligations and interest on savings bonds is in box 3. Why do they break this apart? Well, although interest from savings bonds and treasury obligations are subject to federal taxation, they're exempt from state taxation. And so they are a subtraction from your income for state tax purposes, and they're broken out separately so that you can correctly recognize them on your state tax return. That's the primary reason. Box number 4, our friend, tax withheld. Investment expenses. These right at the moment aren't terribly important unless you're doing your return as a trader and considering yourself in the business of trading for Schedule C. There are expenses sometimes associated with the trading of bonds, and obviously if there's a preferred stock or a note sometimes that pays interest, there are investment expenses with it. Those expenses are reported in this box. In prior years, those were a miscellaneous itemized deduction, but as we all know, miscellaneous itemized deductions no longer exist on any of our returns. So it's not a very important piece of information, but still appears. Foreign tax paid, if you own a bond that is issued by a foreign issuer from which there's foreign tax withheld when the interest is paid by the government of where the entity is located, that is reported here. That goes on Form 1116 on your tax return. It reduces your tax owed, so it's an important credit to take against taxes owed. Foreign country or U.S. possession, that means what country withheld that tax. Box 8 is tax exempt interest if you own a municipal bond. That appears there. And some municipal bonds that were issued for very specific purposes, and there's a long list of them, are subject to the alternative minimum tax, their interest. This is less of an issue since they've changed alternative minimum tax, but box 9 is that adjustment, the interest that is subject to alternative minimum tax. The amount in box 9 is also included in box 8, so don't double it up again. Boxes 10, 11, 12, and 13 have to do with market discount and market premium, either on regular investment bonds or on treasury obligations or exempt bonds. This is one of the things that's hard to explain without a piece of paper. But if you have discount or premium, you're to amortize it over the life of the bond. That's what these boxes are reporting, the amount to amortize in that year. So moving onwards, we're going to go to original issue discount. So I'm going to define what original issue discount is in the very basic sense, although it can be much more complex than that. Original issue discount comes from the concept of a zero coupon bond, where you buy a bond at a deep discount and it then matures at its face value without ever paying out interest in cash. And that is original discount interest. The interest, however, that you don't get paid in cash has to be recognized for tax purposes annually. So if you buy a bond for $9,000 and it's a 10-year bond, there's $1,000 of interest you need to recognize each year without getting cash. That's the easiest explanation of it. Oftentimes you see preferred stocks have this kind of original issue discount or other periodic interest that gets reported on this form. Early withdrawal penalty is much the same as it is on the interest. Primarily you can have this on a very specific types of securities. It's not very common. And again, you have premium and discount. You have the amount for U.S. Treasury obligations is broken out for state tax purposes in the same reason. And we've already talked about the investment expense and bond premium and those kind of things. So they're all basically the 1099 OID is in what it reports is very similar to the 1099 interest, except for the fact that it doesn't necessarily mean that you got the cash. And I think that's the easiest thing to remember the difference about. Dividends and distributions. So 1099 dividend, if you have a interactive brokers account is probably something that almost every account that we hold in our universe gets. And so we're going to spend probably a good bit of our time here. And so I want to talk about boxes 1A and 1B first. And I think this is a place where there are a lot of mistakes made on tax returns. I've seen it happen. And this is also a place where I want to encourage you to look at your dividend report that gets generated in your tax forms. This will give you a lot of the details in a summary form that you need to help you on your tax return. And it's really a preparation tool more than an informative tool on the 10 from the 1099. It gives you details, and sometimes you, like anything else that in taxes, the devil can be in the details, and sometimes you need those details. So 1A is ordinary dividends. Or every dividend, for the most part, that you receive that's an ordinary dividend, not capital gain, is reported in this box. This includes your money market payments of distributions out, dividends. So, and this is a hard concept because we think of money market funds really paying interest, but by definition, they pay dividends. And by definitions, they're all ordinary, taxed at ordinary income rate. So then let's get to qualified. What's a qualified dividend? A qualified dividend is a dividend paid by a U.S. security or a foreign security issued by an issuer in a country with which the U.S. has a tax treaty, or that is traded on a major U.S. exchange, and that you have held for 61, because the dividend payment date doesn't count, days around the dividend payment date. However, what gets reported in 1B is any dividend that is eligible for qualified treatment. Qualified dividends are taxed at the long-term capital gain rate, so either 0, 15, or 20, rather than the ordinary tax rate, which depends on which bracket, but it can be as high as 37.5%. So you want like ordinary dividends, but you have to meet this criteria. So if you own a security for 10 days, and during those 10 days you get paid the dividend, and it's from a U.S. security, so it will be eligible for qualified treatment. That dividend will get reported in box 1B, but it doesn't meet the criteria. You didn't hold it for 61 days. So you've got to back it out. The dividend report gives you that specific information. It will tell you how much of your qualified dividends actually meet the criteria. So you might want to take a look at that. Total capital gains distributions, obviously these are long-term capital gains distribution, gets long-term treatment at the on your tax return. Schedule D reporting from mutual funds in general, or ETFs sometimes, but generally mutual funds. And unrecaptured 1250 gain is also something that goes on Schedule D. Generally, this is one form in a tax preparation software. So if you're looking at TurboTax, this is all going to match the boxes that you have on TurboTax or something to put that into. Non-dividend distributions. Why would you have a non-dividend distribution? Well, sometimes you'll have a distribution that is not a dividend that has to do with a capital repayment, especially in a merger or acquisition. Or if you own a publicly traded partnership that has paid you out a distribution, that is not a dividend. And so that would be reported in there. We're back to our friend box 4, so we're going to skip right over that. Section 199A dividends. Section 199A is fairly new in the tax code. It is the 20% small business tax relief taxation to coincide with the lowering of corporate tax rates. It allows these dividends to be taxed at the maximum rate of 20%. Generally, dividends like this come from investments in real estate investment trusts, though there are some other things that can cause it to be in there. And Section 199A dividends are you need to enter that so you get the tax rate right. Investment expenses, same thing. Used to be an important thing, less so today. Foreign tax paid and foreign country, same as back over in the 1099 interest, though more common on this form. And back to that dividend report, one of the things you're going to know to get this to work correctly on a Form 1116, and there's a lot of nuances in this area, so we could probably spend an entire hour on foreign taxes and crediting foreign taxes. One of the things that you need to know is how much dividends generated that foreign tax and how much were ordinary and how much were qualified. And so the income versus the tax paid, that too is on your dividend report. And I, again, encourage you to look there to make sure that that happens correctly. Cash liquidation distributions, again, if a security is liquidated, generally again in a merger or an acquisition, generally an acquisition, that distribution will be there. Why is that important? You could have a gain or loss that's reportable as a result of that, and that's not necessarily going to show up in your 1099B. It's going to, some of that information comes here. Confusing way to report it, but it is how it happens. And non-cash liquidation distributions, say for example, if security X gets purchased by security Z and you get, instead of cash, you get security Z stock, that would again happen here. There might not be any gain or loss to report. The basis may roll over, and that's generally most of the time the case, though it can be much more complex than that. Those get reported there. The value of those gets reported there. Exempt interest dividends, if you own money market mutual funds, in other words, so if you have a muni money market fund, those are tax exempt dividends. They're exempt from federal tax, may or may not be exempt from state tax, depending on the state situation. Those dividends are reported there. Again, some of those can be subject to AMT tax. That amount is in box 12. Anything reported in box 12 is in box 11. Anything reported in box 1A is reported in box 1B. So just remember that. The trick here is to make sure you pick up these boxes as you enter them into your system. Moving onwards. Miscellaneous income. Well, we've already talked about that this form changed for 2020. And good news, it changes again for 21. So they've already issued a new form for this. So we're going to have something more exciting to talk about for this time next year. And why do you have this form in a brokerage account? Because the first thing on it is rents. And likely you're not going to get a rent, right? But it also has royalties. And for those of you who are invested in oil and gas and some of the real estate trust, and sometimes there's actually one security that trades in copyright royalties. Those would be reported there. Primarily oil and gas and timber in box 2 in royalties. Other income. Once in a while, there is something that gets reported out from a security rather than as a dividend as other income. Goes in box 3. And we've already talked about box 4, but it's there again, our friend. And then let's talk about box 8 a little bit longer. Substitute payments in lieu of dividends or interest. If you participate in Interactive Broker Stock Loan program, you may loan out your security, and if there's a dividend paid while your security is loaned out, you don't actually get the dividend. You get a payment in lieu of that dividend. Same amount, but it's a payment in lieu. Likewise, if you loan out an interest-bearing security, that happens the same way, and it's a payment in lieu of interest. These payments are substitute payments, and they are always ordinary income. So if you normally would get a dividend on, let's use IBM as an example, IBM, and you normally get $500, that IBM, because you would have owned it most likely for over 61 days, would be eligible for qualified treatment, but you've loaned it out, you got a substitute payment instead, it's now ordinary income. So it's one thing to remember about loaning out your securities, that it changes the nature of the payments you receive. Again, something that's commonly mistaken. A lot of times people take this box 8 and throw it right up into the dividends, and it doesn't work that way. It really is ordinary income. So, and it taxed at the ordinary rates. So something again to remember. Now let's move on to the 1099-B. IBKR breaks this up into 4 reporting 1099-Bs. And there are 4 summary 1099-Bs. Now, why do we do this? We could lump it all together and make it all be the same and put it all on one form. And frankly, because again, as I started at the beginning, I approach this as a user. I want to make this easy for you to take the information. Oh, there's that number, plunk it right over in there. Oh, there's that number, plunk it right over in there. So in other words, I want to speed up your job at the end of the year preparing taxes, or your tax preparers, because obviously the less time they spend preparing your return, the less they're going to charge you to do so. The easier it is for them, the less they charge you. Open your envelopes, please, when you take your stuff to your tax preparer. You know, you really don't need them to pay them to open your mail. And you would not believe how many people just deliver everything to you in a shopping bag with the mail unopened. It's very annoying as a tax preparer. So let's talk about this page. This is page 2 of your consolidated 1099 form. It is the first box on the upper left side is covered securities short term, and this is the summary. Well, let's talk about what a covered security is. Beginning in 2010, certain securities, and it was a phased in law, so it started with stocks first, and then it moved to mutual funds, and now it's moved to bonds. And so not everything is a covered security, but most things are. And a covered security is one in for which, if it was purchased after January 1st, 2010, that the basis is reported to the IRS. In other words, what it costs you to buy when it's sold. And as I said, this phased in. So it's not, if you bought a bond on January 1st of 2010, that wasn't subject yet. It didn't become subject to later. So it's a phased in law. So it took us about 5 or 6 years to really get there to cover everything. But anything, the starting date was 2010. So these, anything short term, which means that it's been held for less than a year, pretty much is a covered security, unless it's by definition never going to be covered. And we'll talk about those at the end when we get to them. So a covered security short term, the basis gets reported to the IRS. Because this is a summary form and it can be made up of multiple transactions, you don't have the description, the dates, and at the top. So 1A, 1B, 1C don't really apply for the summary form. If you look backwards, the detail is all in your 1099. Every transaction's there. More useful, in my opinion, is you get Form 8949 worksheets. That's a gain loss worksheet in your with your tax forms. That'll show you the transactions in the format that it goes on your tax return, which sometimes makes it a little bit easier to see than it does on this. You have, first of all, first box that's important on the summary form is 1D. That's the proceeds. That's the total amount of proceeds you got, less the commissions, less any expenses, less any options premiums. 1E is the cost, what you paid. The accrued market discount, if you had any bonds in that group. 1G is wash sale loss disallowed. The wash sale rules are, if you sell a security at a loss that you have purchased within 30 days either side, so you could purchase it 30 days before or 30 days after. So you buy something, You sell it at a loss, you buy it right back. That loss is disallowed. You can't take the loss when you sell it, and becomes part of the cost basis of that lot that you bought afterwards. Confusing. I don't, and it's very difficult to explain, especially without drawing it out to me anyway. So let's say you buy 100 shares of stock X, and you buy another 100 shares of stock X, and you turn around and sell the first group that you sold, first 100 shares that you bought, at a loss of $100. You cannot take that loss because you bought that second 100 shares within 30 days. Okay? It becomes part of that cost basis of that second 100 shares. When you sell that second 100 shares, it'll get recognized. It's not lost, it's just delayed. It's a timing difference. So I hope that's clear, because again, we had that's another topic that could be spent serious time on. So we have the rest of these boxes. Our box 4 is there again. And the rest of this is more informative. The details are there in the back. So moving over to the right-hand side, these are securities long-term. These are securities that you've held for more than a year. Now, let me define long-term. Everybody thinks that if you buy something on April 4th, you can sell it the following April 4th. That's not a year. April 5th is a year. The first day you buy it doesn't count. So you've got to own it a year. So it's not April 4th to April 4th. It's April 4th to April 5th. Don't get caught in that trap, because I've seen people get caught in that trap and be shocked that they had a huge short-term gain when they meant for it to be long-term, because they thought they'd waited long enough and all they needed was one more day, but they needed that one more day. So this is exactly the same as what's over here for short-term, except that it's long-term. These, if you want to, and there's nothing that says you did this, if this is, each of these summary forms are made up of multiple transactions. You may have hundreds of transactions in your summary form. It could be made up of 5, or it could be made up of 100, or it could be made up of 1. You can just report the totals. So in other words, you don't have to list all 100 transactions. You only have to list the totals for covered securities, and you can say as reported. So you would say Interactive Brokers short-term as reported, and just put the totals in. You don't have to put all the transactions. For long-term too, covered securities only. Covered securities only. So we're going to go to non-covered securities. We talked about what makes a security covered. So you might have something that you bought before 2010. So remember, at that time and place, the brokers were not charged with keeping your cost basis, so you need to know what it is. On your form, on your 8949 worksheets, we will have a cost basis if it's a non-covered security. It may not necessarily be right. For example, if you transferred it in from another broker, it's likely it shows the value at the date it was transferred in, not the value you purchased it at, because we would not have been given the information. Second reason is if there's been some kind of corporate action, not a split necessarily, but a merger or a spin-off or something. Those numbers prior to 2010, we were not tracking, no broker was tracking accurately. So I would check those numbers. So if it's uncovered, there's also certain securities that are uncovered just in general and have no place in the law as a covered security, so there's no plans for them to be covered. And those are primarily publicly traded partnerships. Publicly traded partnerships are non-covered securities, so you need to track the basis for those yourselves. So again, This is exactly the same thing, except that there's no number. So there's no box 1E, no cost basis, because we don't have to have it. So this is where you need to enter and look at the transactions that you had and enter each one separately, because we've also not determined the term. It's possible to have a short-term transaction in here. It's also possible to have a long-term transaction here. You need to go and look at what was traded here. You need to go to the details. Here is where the devil is in the details. And these do need to be entered individually in your return. You can't just lump them all together. So that's important to remember. These do require a little work. Final 1099-B on this page is the section 1256 transactions. For those of you who trade regulated futures contracts and options contracts, they are considered section 1256. What is section 1256? And that's what everybody talks about on this. It's a IRS code section, obviously section 1256, that says these types of transactions you mark them to market at the end of the year and recognize that gain or loss. And you consider that 40% short term and 60% long term. So they have a special tax treatment too. And of all these boxes, the first thing it shows you is what profit or loss you received in 2020 on closed contracts. Well, that's great. That's the total profit and loss, not what you've recognized, just the total profit or loss. So if you bought something in 2019, you would have marked to market at the end of 2019 and recognized that on your tax return. And then you might have sold it early in 2020 and only had a little bit more profit, or even had a little loss from what you'd already recognized. So that's not the number you want. If you're a very sophisticated investor, there's reasons why that number is there, but we're going to assume that you're a regular person and going to treat these like most of us would. Box number 9 is the portion of that contract that you owned in 2019 that you recognized. Box 10 is for those same contracts that are open at the end of 2020, what you're going to recognize. And box 11 is the number you really need to go in your tax return. So I generally worry about box 11. There's reasons I might use 8, 9, and 10 if I have a sophisticated investor and a sophisticated taxpayer, but most of us only use box 11. So that's the easiest thing. It goes on a very specific form. And of course, right now, because I'm talking and I'm trying to do this, I can't think of the form number, but I'm hoping I wrote it down here and that I have it. It's form 6781. It's form 6781. So that's, if you have reporting in this 1099-B, you want to be looking at form 6781. And again, we also provide for you information. There's a gain and loss worksheet, and it's a worksheet that backs this up and gets to these numbers. So it helps you get to what you think. Now, I'm going to stop right here because I've got a couple more things to talk about. I want to talk about amended forms a little bit. I want to talk about some IRS notices, but I want to know if there's any questions that anybody will ask. If you put them in the chat box, I'll be able to see them, or the audience will be able to see them if you do it to all the audience. And I want to stop so that I can open this up to questions if you want. So I'm going to give you a couple minutes to think of that, because there might be something that you need me to talk about. I want to, while you're thinking of your questions, I want to talk for a minute about publicly traded partnerships. Publicly traded partnerships, when you get a payment from them, it's essentially a change in your basis. It reduces your cost basis. At the end of the year, you will get a K1 form. This does not come from IBKR. It comes directly from the company. Again, we don't even see them as a broker. They come directly from the company. If you're wondering where yours are, Go out to the company website, go into investor resources, and generally there's places there to find your K1 for the year. It's a little early yet for those, so I would think that you might wait a week or two before you think that you're going to have those. You are required to track your basis. So if you buy a publicly traded partnership, $10,000, over the course of the year, you get $1,000 back. Your cost basis is now $9,000. You will get a K1 on which there's income to recognize. Let's say there's $1,200 with it recognized. Your basis now is $10,200. So that's 10,000 minus the 1,000 that you received to 9,000 plus the $1,200 you recognized in income brings you to 10,200. A lot of the publicly traded partnerships now give you that when you sell your securities, but not all of them. So it's something you've got to be aware of as a trader. And I'm not seeing any questions. So either I've done a really good job or everybody's gone out to lunch. So I'm going to move onwards. I've got a couple of I want to talk about amended forms for a minute. And when you get an amended form, and this is a picture of one, and it just has got a couple of examples on it, it will say amended. They are not uncommon. And I strongly suggest that if you went out into our system and pulled your 1099, your consolidated 1099 out at February 15th and said, oh, I'm all ready to prepare my tax return, I never have to look at this again, I'd go back and look at it a second time. It's possible, fairly even likely, that it has been amended since you pulled it down on February 15th. And I certainly think that if you go to extend your return in April because you don't have all your information, the IRS has already come out and said that they are not extending the filing date this year from April 15th. So don't plan on going to July. You're at April 15th. No vacation this year. I'd go back and just double check that you don't have an amended 1099. Especially if you extend your return to October, I'd go back and look and make sure you don't have an amended 1099. What's the foul here if you don't? Well, if you report the old number, you're going to get a notice that says, IRS says, no, these didn't match. Where is it? Where's my money? Why don't they match? So nobody wants to deal with an IRS notice. I'm also going to say one more thing about filing this year. The IRS is still processing paper filed 2019 returns. Still processing paper filed 2019 returns. They're still processing returns that were paper filed in April. Paper file. In other words, if you're not electronically filing, think very long and hard about doing so this year. And if you do, for some reason, paper file, make sure you have proof that you've mailed it and the date that you mailed it. In other words, either a post office tracking number where you've pulled off the tracking and showed where you mailed it and showed where it got delivered to the IRS and stapled it together and put it in your tax file, or certified mail that shows you've mailed it. Don't neglect this because the IRS is issuing non-filing notices left and right, and they admit it, but they may have the return sitting in a warehouse because they haven't processed it. So it's one of these things the computer doesn't see it because they haven't processed it, so it issues a notice, but they haven't. So you're going to need to be able to prove you filed in paper. Extremely, extremely important this year. Normally, I would say if you had a small return, don't worry about it. Not this case. And seriously consider electronic filing. Most of the returns in this country are now electronically filed. If your preparer is not electronically filing, question your preparer because almost every state requires preparers that prepare more than 25 returns to electronically file. And so the IRS does too. So if your preparer is not electronically filed, has not been doing electronically filing for probably close to at least the last 5 to 10 years, you need to question that person on that process, because that says to me that they are not staying up with the rules and and is aware of this. So that's just a caution on your thing. So if we amend your consolidated 1099, it will say in big red letters up at the top, amended, as you can see on this one. And if something changes down at the bottom, it will say amended, the date it was amended, and what it was. Now, why do we date these? We've had situations, especially in the dividend area. We've got new information on one stock on Tuesday. We produced an amended 1099 that night, and it's posted. And then Thursday, we'll get new information on a second stock, and we've got to amend again. So you want to make sure that you've got the latest date if you have an amended 1099. So you could have this happen 2 or 3 times, and you want to make sure you want to get the latest one, or the one that's closest to the date you are at. So let's talk about IRS notices. My friend, the CP2000. What's a CP2000? We've probably all gotten them. They're a notice that says we have something that's been reported to us, the IRS, by a third party that should be on your return that we're not finding. So it might say we got $10 of interest reported from your piggy bank that you should have put on your on your tax return, but you didn't. Where is it? You owe tax on that amount. This is a very common notice. My first thing is to say, please don't panic. Secondly, don't sit it aside and leave it to the day before it's due. Deal with it and be done. Generally, I find that if I pull out the tax return and I've missed it, they're usually right. The thing to remember is if your CP2000 notice is about missing dividends, they will treat all those dividends as ordinary dividends, assess tax as ordinary dividends, so at the full amount, and some of them might be qualified. I had one person who got this recently, one of my individual people. They had not given me the 1099-B because it was a new brokerage account, so of course I didn't know I was missing it. Makes it hard for us tax preparers to get things right when you don't give us everything. And there was $10,000 worth of dividends, and the IRS assessed almost $5,000 worth of tax. They're a high tax bracket taxpayer. But all those dividends were qualified. And so if you did an amended return and actually figured the tax, they owed about half that much. And so it's important to go back and figure the tax too, if it's not something straightforward. So first look and see if it was on your return. It might have been on your return in the wrong place and you still paid the tax on it. And the IRS is okay with that. But it also might not have been on your return because you might have forgotten you had it. And we all have done that. And it might not be the right amount though. The same thing is true for if it's on a 1099-B, they will not figure out the gain or loss. They will tax you on the proceeds. So again, go back and find and do it right. Amend your return, just even if it's just to check them. And you might never submit it, you want to check their work. And then there's the general notice that they want to look at something or they don't like something. And this kind of falls into the group states may issue these, particularly if you live in states where they're aggressive and you've moved out of them. So New York, New Jersey, California, Illinois is aggressive, Michigan's aggressive, Ohio can be aggressive. So if you move out of those states, especially to a non-tax state tax jurisdiction, Texas, Florida, one of those states. So you become you move to Florida, you move from a high tax state. That high tax state doesn't like to lose you. They're likely to challenge you. This is the kind of things, this is why good record keeping is important. Again, first thing is not to panic. Second thing is, and I always tell my people, especially those that are moving from these high tax states, to keep beyond superb records that year, because the IRS and the states will even pull your cell records to make sure you're not in the state. So just be aware of that. Some of the states are very aggressive, much more aggressive than the IRS in some respects. So the first thing is to deal with it logically, consult your tax professional, and don't set it to the side. Don't let it go, oh, I'll deal with that tomorrow. Tomorrow will come sooner than you can. And sometimes dealing with this stuff is faster, is easier to deal with right away. Other thing right now, again, goes back to my processing comment. Generally, all these notices get answered in paper. Be sure you answer them. Be sure you have proof that you've mailed them, because the IRS is so far behind because of the pandemic that you want to make sure that they've got that. I think we've come to the end here. And here's where to send any questions. And I think we have a couple of minutes. It's just 3 o'clock, so if I understand if people have to go, but if we want to take a couple of minutes, there are several questions. That's what somebody says, and they're not showing up to me. So why am I not seeing these in chat?
Hi, Nancy, it's Andrew. Let me help you with that.
Okay.
So there's the chat panel, but there's the question panel. You should be able to see that. Can you not see it?
Ooh, that's a good question. Hold on just 1 second. And this is a new webinar. Maybe I do. I do. Hey, all right. I just didn't know that was different. Could I please discuss foreign exchange gain or loss worksheet from the IB cash card, as FX gains don't appear to flow into the 1099? Are they capital gain for 1065 and 1040? Thank you. Okay, so let's talk about foreign exchange capital gains. Foreign exchange capital gains and losses are not reportable on 1099s. So that's why they don't flow into 1099s. They are not part of the 1099 reporting. So not required, not reported. Foreign exchange capital gains or losses are only recognized when you trade out of the security back into your base security. So if you, and I want to run through this really quickly, and so if it's too fast, come back to me. If you take US dollars and buy British pounds, you take those and you hold those British pounds for a while and the pound is way up. So let's say you have a gain. You take those British pounds and you buy euros and you hold the euros for a while. And then you come back to US dollars. Let's say you originally invested $10,000. You're going to come back from your pounds to your euros to your dollars, and you now have $12,000. You have a $2,000 gain. It is recognizable when you go back into dollars. It is not recognized when you go from pounds to francs. All foreign currency gain or losses are ordinary income. Ordinary income. They are not capital gains for Form 1065 or 1040. They are ordinary income. That's actually section 990 of the code if anybody's really interested, but I'm surely sure you're not, because if you want bedtime reading and you want to snore, read the tax code. So anyway, I hope that answers your question, but they again are not part of 1099 reporting. We provide that gain loss worksheet to help you calculate it. It's more there again as a preparation tool, because you do need to figure it out. But the problem is you don't. Now, if you have a foreign currency gain or loss as a result of buying a security, so you take dollars, put it into pounds, buy some kind of security, sell that security in pounds, and bring it back to dollars, that becomes part of the 1099B and is part of your gain or loss. So it's really it really breaks into two different types of transactions. If you're talking pure currency, it's ordinary income. If you're talking currency to security, security back to currency, back to base currency, then it's part of the gain or loss for the transaction of the security. Confusing, highly confusing. So it depends a little bit what you do with your currency when you get it. Okay, I've received updates by to my tax statements from Interactive Brokers in the past. By what date should I plan to file with my forms being most updated or complete? It's almost an impossible answer to answer you. I would suspect that due to the pandemic, that a lot of the reporting is late. I know one broker in particular has had significant issues issuing any 1099s to their customers, and this is a problem every year in normal circumstances. I would like to say that I think the majority, unless you own something that has had a significant corporate action on it, or or something that has had something like that, or a very unusual ETF, that your tax information should be fully updated probably March 15th, as usually by then we have everything that's going to come, or the majority of everything. That doesn't mean it won't change, but I would think March 15th is a safe date. So got one for backdoor IRA non-deductible conversion. Okay, so if I would suspect that this has to do that you got a 1099-R when you converted, either transferred from another broker to IBKR for a transfer, IRA to IRA, or you transferred your 401k into a broker then you generally get one from the 401k as a distribution. If it's a rollover, a qualified rollover, you may get reporting. It's not wrong. You will also get Form 8949, I believe it is, that comes out May 31st that shows the contribution. This is the reporting rules. They don't necessarily match. Doesn't mean it's taxable. So I would suggest that if you got the 1099-R, that you make sure that it's in the account, an appropriate IRA account, report it as a non-taxable transfer on your tax return, which means it'll show up in the middle, but not in the part that adds up on your 1040. And that way you won't get a notice, but it is the way the reporting works. Unfortunately, it's not consistent with how it works. I also want to point out that if you are making a distribution from a qualified plan, such as a pension plan or a 401k plan, to an IRA, that there's limits to how many times a year you can do that. For now, used to be able to do that 100 times a year. You can only do it once a year now. So just be aware of that. Is there any resource on how to handle that? I'm assuming that the backdoor IRA. If you, again, if you look at the instructions concerning IRAs, and there's a publication concerning IRAs, and I don't know the publication number right out of the top of my head, but if you go to irs.gov and go to publications and search IRA accounts or retirement accounts, it'll be in there and you should be able to find it. And that's a good way to deal with that. There'll be further instructions. Got 1099 missing cost, but the cost value is available in 8949. Should I use? Okay, these are the non-covered securities that we are talking about. The answer is that, so there's a 1099. It doesn't have any cost basis on the 1099, which means it's uncovered. Person didn't specify what kind of security is. There's a cost basis available in the form 8949. Should he use that? The answer is maybe. I would check it. If it was something you bought prior to 2010, the burden's on you to track it. So I would go back and find out how much you paid for it. In Yahoo Finance, there's a way to calculate through any corporate actions, splits and stuff, since you bought that, and figure out your cost basis. If it's not that kind of a situation, or if it's a situation where it got transferred in maybe from a foreign broker that wasn't subject to cost basis reporting rules, then the burden's on you. You've got to figure it out. And the amount that's shown in R8949 and the date will be the date you transferred it in, not the date you bought it. Might make a difference for your term. I don't know. The final reason is that it might be a publicly traded partnership or some security that's not subject to cost basis reporting. And there again, the burden's on you to track that, you as the taxpayer. Our 8949, I can tell you right now, for publicly traded partnerships will not be correct, because we don't get the information to make it correct, because we never see the K1s. So we can't possibly make those entries. So the answer is no. It also might be a security that you bought prior to 2010 at Interactive Brokers. That might be right. We will have accounted for the splits. Likely we will have accounted for corporate actions, but I would still check it, because the corporate action reporting into our system and to everybody's system at that point, prior to 2010, wasn't very good for cost basis, because there was no need for it to be very good, because brokers weren't charged with tracking it. So anything prior to 2010 as a cost basis is suspect, I would say. And again, that's kind of what that we've all gotten spoiled with cost basis reporting, but realistically, if you've been around long enough, you know that it didn't always exist. Will there be another webinar for K1 forms? We don't have a webinar for K1 forms. It might be something that we consider, Andrew. We can do that. We've never done it because, of course, we don't see it. But I would suggest that a lot of that there are some out there, and unfortunately, they're ones you're going to have to pay for. But it's something we could consider doing, and we'll talk about it amongst ourselves and the people, the powers that be, that decide what webinars we do, and maybe we can do something with it. Who can be exempt from the wash sales rules? Nobody. Unless you are a mark-to-market trader where you're recognizing and marking to market every day, you're not exempt from the wash sale rules. And that's the only situation. You would have to qualify as a trader. You would also have to make the mark-to-market election by April 15th for 2021. There is no extension. So if you live in Texas and have an extension to file your return until June 15th, the election doesn't extend. That's what you, but nobody is exempt. So move onwards, you might as well forget it. I've already discussed the FX worksheet, so I'm going to move on from that one. I've answered that one. And if we use the TurboTax file provided by IB, using this file, does it update all the dividend information into TurboTax? That's a good question. It should, but I'm not absolutely positive it does. But I will go, if you send me an email to this address, I will go ask the person who will know and come back to you. So if you shoot me an email with that question, I will find the answer for you. The interface between IB and TurboTax, we've had issues with it in years past. It's gotten a lot better and a lot more seamless in the last few years. So, but exactly how that works, I cannot answer on the dividends, and I will find out if you shoot me that email. You definitely do not need to enter each dividend manually. You only need to enter the totals if it doesn't come over, but I think it does come over now. The last one of the questions here is, when is the last time I should expect to receive an amended return from IBKR? As I said, I would think March 15th is fairly safe. However, we have gone back and amended 1099s, and it's usually because there's been a court case amending information that we've had that has wound its way through the court as long as 2 or 3 years later. So the answer is that there isn't really a time limit on this, but March 15th is, again, where I would start to think you're safe. More questions about the wash sale rules. The question is if you buy 100 shares of stock one day, 80 shares the next day, and then sell the entire 180 2 weeks later, I'm assuming you have no other position in the stock and have bought and don't buy anymore for 30 more days, then the loss is not disallowed. It would be allowed. That's not what the wash sales rules do. So you would get that loss at that time. And then if the IRS cashed my payment check with my 2019 return, is that the proof that they received your tax return? Maybe. Your payment, if you electronically filed, went separately from your return. So your return went electronically, your payment went with a 1040V, just a voucher that says I'm making a payment. It's usually tax preparers can set their and TurboTax does this too, that you get a notice once the IRS has received your return if you file electronically. All the big software providers provide that, including TurboTax and including H&R Block's system. So I know that those two systems will give you notice that both the federal and state returns have been accepted. Cashing your check in and of itself, yes. But remember, I will give you a great example. That's one of my personal clients. I have a personal client that we filed the tax return in March, right as the pandemic is starting. They still haven't cashed the checks. The check is no good. And they claimed in July they hadn't received the return. So we sent them a return again. They claimed about 2 weeks ago they still hadn't received it. So now they've got it twice, and we can prove that they've got it twice. So they're that far behind on processing. So I would, at this point, this is not the year to be cheap on what you spend on mailing. It's going to cost you about $7 to mail it certified return receipt, or $7 and some odd cents to mail it with tracking. Don't be cheap. Your time is worth more than the $7 you're going to spend to mail it if you have to answer a notice or refile or are late and owe money. So, it's the old saying, don't be penny wise and pound foolish. I'm not sure I understand this question. After the stock went down, I bought another 80 shares. If you don't sell it, I think this is a wash sale question. I'm assuming that you bought some more when it went down and hung on to it for a while. That has nothing to do with the wash sale. It's all has to do with buying it, selling it at a loss, and buying it back within 30 days. How are IRAs taxed when you take them out at the correct date? Do they look for short and long-term gains? The answer is traditional IRAs. So we're going to talk about Roth IRAs are not taxed when they come out at all because they're after-tax money. That's the current law. And I'm being very specific about that because the Obama administration proposed a change to those rules for Roth IRAs and to make some of their earnings taxable. I would not be surprised with the change in administration to see that come up again. Doesn't mean it'll pass, just means that it could come up again. But if we're talking traditional IRAs and inherited traditional IRAs are all ordinary income when they're paid out, even at the correct age. So if I reach 59 and a half and I start drawing down my IRA, it's going to come out as ordinary income. So that's one thing to remember. And it's also something that I think befuzzles some people, because if you have a traditional IRA and money outside your IRA, and you get to be elderly and don't have a lot of other income, you're not working, you have Social Security, which may or may not be so much, your tax, but you intend to leave that IRA to your children might actually be in a higher tax bracket than you are, and you might be better off to use your IRA, the money, and pay some of the tax than leave it to your children, because they'll pay more tax than you would have. Something to think about. It's a trap sometimes. The other thing is don't forget that if you have a required minimum distribution, meaning you're above age 71, you don't really need that money and you have a charitable intent, or you don't really need all of it and you have a charitable intent, that you can give your required minimum distribution or a portion of your required minimum distribution to a qualified charity. So if you have a charity that you normally make a contribution to, let's say you normally give them $500, instead of taking your IRA money and then giving them $500, you can give them $500 directly as part of your required minimum distribution. Then it doesn't go into your income. So that's something else to consider. Let's see, we have a few minutes to go. From traditional to Roth IRAs. So I'm assuming, how does a conversion from a traditional IRA to a Roth IRA get taxed? When you make that conversion, and you have to, this is where that wonderful form that I talked about, Form 8606, comes into play again. Let's say you have a traditional IRA that has $100,000 into it. Assuming that it is all pre-tax money, meaning it's gone in without having any tax paid on it, and you convert it to a Roth, you pay tax on that $100,000 when you convert. So ordinary income. Now, there have been discussions in the press that, especially last year and this year, so far this year, assuming we don't have a tax bill, are good years if you have a large traditional IRA and want to convert it to a Roth. This might not be the worst time in the world to do it, because the tax rates are as low as they've been historically. So it's something to think about. If you have a traditional IRA that is some pre-tax money and some post-tax money, so in other words, it has some basis, the percentage again gets taxed when you convert to an Roth. Now, this is a little bit complicated. Form 8606 is a little bit complicated. So it's someplace where you really want to, if you're doing this yourself, really want to take the time, read the instructions, and make sure you've got it right. Okay. Can we have a webinar for backdoor Roth conversion from a traditional IRA? Well, we don't probably need a webinar for that, because it's probably a 10-minute explanation. It's easy to do. But it's something, we do have an IRA webinar or part of the Traders Academy, and I believe that topic is covered in there. And again, that's a topic, IRAs in general is a topic that we could consider a webinar on, and we'll put that on our list to discuss again with the people that are more important than me, and we'll see what they say. For master limited partnership, dividends are not qualified. Do I adjust the basis by sold my entire position, include the dividend income that way, and also include the K1, or would that double count the dividend from the limited partnership? Let me start at the beginning. You've got this backwards. So the dividends are looked at as a return of your capital or return as your investment. They reduce your basis. The K1 increases your basis. So You've got a $10,000 investment. You get a $1,000 distribution. You now have a $9,000 basis. Then you get a K1 with $1,200 worth of income. You recognize that K1 on your tax return, recognize the income. Your basis in that MLP is now $10,200 when you sell the position. So that's the number you need to use. Okay. If I have 10 brokerage accounts and only one has wash sales, can I do summary reporting on the 9 accounts that don't have wash sales and list each capital gain transaction only on the account with wash sales? Yes and no. If you have 10 brokerage accounts and first of all, the rule is that if you look at the wash sale rules and the gain loss reporting rules, generally that's first in, first out. It is not account specific, it's person specific. So we're going to wrap this up shortly, and the answer is if you don't even have to report each of those wash sales individually. But this is an area that's going to take longer than the time we're already over. So I think what I would like is if you again will send me an email, I will address this question specifically and tell you how to do it. But I think you've got other issues than just your wash sales. Someone has asked about day trading and wash sales and how to calculate them on futures. I'm going to have to go. The one you've cited is a 1256 transaction. So we're going to have to talk about this a little bit. I'm going to take some of these offline and ask them. And so answer them. If anybody who doesn't get their question answered, I'd encourage you to send me an email and I will get it. Someone's asked about the mark to market. I don't know the form number off the top of my head, but I will look it up for you. And if you pay IRS through direct pay for extensions, is the receipt good enough in case they claim that they have not received the payment? Yes, it is. And if you convert an IRA to a Roth IRA, can this amount satisfy minimum distributions? The answer is if you've reached the point where you have received our 70.5 and you convert, the answer is basically no. So I am going to wrap this up here real quickly. If you didn't get your question answered or I told you to email me, email to this address that's on your screen, and I will answer you. And because a couple of things like the form number, I just don't know off the top of my head. Secondly, if you have any more questions after we wrap up, send it to there. We will consider we'll talk to the powers that be about K1 webinar and an IRA webinar, because it seems like we've got a lot of questions on that. And if you have any other ideas for us, please send them to the email. We'll look at them and we'll see what we go. And I encourage you, I'm happy to answer your questions. It's just that we've run out of time, way out of time. So let's go, and thank you again for your attendance today.
Thank you, Nancy. It was brilliant.